Hey everyone, I hope you had a wonderful 4th of July holiday. So I'm going to just dig in here. As I talk to investors, they often identify two issues that are weighing on their investment decisions. The first is interest rates, and the second is the overall level of uncertainty. Since March of this year, interest rates have largely been range-bound between 4.25% and 4.5%, with a downward trend in recent weeks. But it's the uncertainty that has weighed on investors' minds most. Following the enactment of Liberation Day tariffs at the beginning of April, uncertainty surged to its highest level ever. But uncertainty tapered in May and June as President Trump enacted a 90-day pause on most of the tariffs and as generally positive economic data continued to roll in. Even though the tariffs are at their highest level since 1936, about 6.5 times higher than they were last February, I think a lot of people have mentally adjusted to the new tariff climate. In a way, I think a lot of people are filtering tariffs into the background noise at this point. But in the coming weeks, we may see a resurgence of uncertainty as the 90-day pause on tariffs expires and as the implications of the new tax bill become more apparent. Although some tariff deals have been made, one with the UK and a loose agreement in principle with China, tariffs are still elevated. The current overall effective tariff on Chinese goods is 27.9%, and there's not really much clarity on what will happen once the pause expires. America's largest trade partner, Mexico, has a current effective tariff rate of 10.7% after combining the products that have zero tariffs under the USMCA agreement and all the other goods that are tariffed at 25%. The US's third largest trade partner, Canada, has effective tariffs of 11.2%, again integrating tariff-free USMCA goods with the other imports that have a 25% tariff. All other countries have an effective tariff rate of 11%, with a 10% baseline tariff coupled with a variety of other tariffs, including a 25% tariff on autos and 50% tariffs on steel and aluminum. But when the 90-day pause ends on July 9th, all of the tariff policies could change again. Most economists anticipate that the tariff rates will continue unchanged. But President Trump recently leveraged the threat of raising tariffs to force Canada to change a recent digital tax policy. So while the baseline scenario is for tariffs to remain where they are, it's entirely possible that they could be changed on short notice. And if that starts to happen, uncertainty could begin to rise again. With regard to the new tax bill, which was hammered through the Senate in marathon sessions all of last week, including a tie-breaking vote in the Senate by Vice President J.D. Vance, there could be a lot of implications. Many of the policies are positive for commercial real estate investors, like 100% bonus depreciation on new acquisitions. But there are other policies like reductions in funding of Medicaid that could raise uncertainty. In addition, this bill went through Congress at lightning speed, so there will undoubtedly be some facets that need additional interpretation. Basically like we experienced when the 2017 Tax Cuts and Jobs Act was quickly shuttled through Congress 8 years ago. That means there will likely be a lack of clarity on some facets of the new tax laws, but whether this will be a significant challenge or not remains to be seen. And finally, the new tax bill will further increase the U.S. budget deficit by an estimated $3.3 trillion over the next decade. And as part of that, Congress has raised the U.S. debt ceiling by $5 trillion. That means more treasuries will be issued over the next few months, which could put upward pressure on treasury rates. As I mentioned earlier, the 10-year treasury has come down in recent weeks to the 4.25% range. If the government follows its April projection, $554 billion of treasuries will be issued in the next 3 months. But since the debt ceiling has been raised, the issuance could be greater than that. And if the Federal Reserve and foreign investors continue to draw down their treasury holdings, buying fewer of the treasuries, the issuance could put upward pressure on interest rates. So while uncertainty has come down over the last couple of months, we might be in the eye of the storm. I'm not saying that uncertainty will surge or that interest rates will definitely be run up, but the probability of these risks are things we need to consider as investors. Once again, investors may want to capitalize on the current relatively low interest rates if possible. And while uncertainty could rise over the next couple months, it will likely settle down again as the tariff policies stabilize and the new tax bill gets fleshed out. So hopefully the uncertainty will just be a short-term headwind. But as I've mentioned in previous videos, the increase of bonus depreciation to 100% this year could substantively improve the first-year returns on new acquisitions. And the long-term commercial real estate outlook remains positive as healthy demographics and the durability of the U.S. economy eventually play through. And that's the opportunity investors need to focus on as they keep their eyes on the horizon.